Despite any type of analysis of shares, fear and greed will always control the market's reaction. And particularly after extraordinary events such as the World Trade Center disaster, that the market will respond in an extraordinary way. So that there are clearly opportunities when these extraordinary market peaks and troughs occur to find shares that have been mispriced compared to their intrinsic value. And an example of that is after the World Trade Center disaster, a share called COMPUTERSHARE, which many of you will hold, quality Australian company. Its share price dropped dramatically on the basis that the market perceived that because of the World Trade Center disaster, that markets thereafter would have little activity, little corporate activity, and COMPUTERSHARE feeds off that activity, so therefore their short-term profit outlook would be considerably hampered. But COMPUTERSHARE also had a convertible note on issue with a face value of $100, with a dividend at face value of 5.5% fully franked. In line with the share price fall, the note price also fell to 78 cents. At that price, it paid a dividend at 7.1% fully franked. But it also had a capital upside of 22% on conversion. Now, these are convertible notes. They were going to convert to shares at some time in the future. So there was a 22% inbuilt capital upside. We bought a lot of them. In 2004, COMPUTERSHARE converted the notes at a face value of $1.02. So our clients enjoyed a 7.1% fully franked dividend for the 3 years, then made a 22% plus upside on the conversion, and then COMPUTERSHARE price doubled. I haven't done the sums, but it's a massive return. And this is an indication of the irrationality of the market and where value can be found in quality companies. Another example, this is my favourite example. Cumberland Credit was a cash box company floated in mid-1987. A cash box is a company that just simply raises capital with the view of investing into other shares over time. So Cumberland Credit raised money and the market crashed in October 1987, and Cumberland Credit's share price dropped in line with the market to 60 cents. It had asset backing of $1.06, but the fact was that Cumberland Credit hadn't bought a thing. It was all cash. So you could buy $1.06 in cash for 60 cents. Completely irrational. So market theories all have some merit, but in reality, these emotional reactions in the market are always going to be an opportunity for the long-term investor. So the efficient market theory certainly does apply, that the market does price efficiently on a daily basis, but it really doesn't apply to a long-term investor. It does if you're a day trader, but for us, it really has no impact whatsoever, because we're looking for intrinsic value, we're looking for opportunity. Modern portfolio theory is broadly used as a reference in today's investment market. And basically, modern portfolio theory relates to the broad diversification across all of the asset sectors. And the theory goes that a broad diversification will always outperform taking large positions in individual sectors. The exponent of this theory, or a key supporter, is US financial advisor Roger Gibson. Now we've seen Roger Gibson speak on a few occasions, and his argument is quite compelling. But in reality, the modern portfolio theory taken to extremes is really a recipe for mediocrity. And if I can give you an example that many of our colleagues that use managed funds will recommend to their clients a mixture of value and growth-based funds. And it's based on this diversification theory, so that when the market is running strong, growth managers will do well. When the market goes into decline, value managers will do well, growth managers won't. So you've got a smoothing effect. Our view is that we want to have longer term reliable results, not smoothing effects. Buffett's view is that wide diversification is only required when investors do not understand what they're doing. So let's look at our role. My colleagues in the industry love to tell me that I'm a fund manager. We're not fund managers. We're private client managers. We're private client portfolio managers. Our job is to design portfolios for each of you individually in order to achieve the outcomes that you instruct us to achieve, and then do that on an ongoing basis. So where are we now? Certainly, it's been a tough 3 years. Certainly the toughest 3 years in my 25 years. And there's no question that there's been enormous upheaval to the global financial markets. But is it really different this time? Let's have a bit of a look at history. History is strewn with boom and bust cycles. Let me give you a few examples. In 1634, the tulip bulb craze. In 1711, the South Sea bubble craze. The speculative craze of the 1920s, followed by the crash of 1929. The soaring silicon chip 60s, where anything electronic was a winner. The roaring 80s and the crash of 1987. The high-tech bubble of the 90s and the tech wreck of 2000. Then the raging bull market from 2002 to 2007 and the GFC of 2008. If you believe the media, it's always different this time. Do you recall back in 2000, where after the tech wreck, the media was all about the new economy, and that old stocks, old blue chip stocks, were now no longer an opportunity for decent investment returns. How wrong could they be? Here we were investing billions of dollars in technical stocks that made no money. And then we were told after the 9/11 disaster, most of the economists and fund managers were espousing the fact that the days of double-digit returns were over and that people would have to adjust their view. How wrong they were. We then entered the greatest bull market of all time. So we just never learn. We keep reacting irrationally. Buffett says, what we learn from history is that people don't learn from history. No, it's not different this time. Market crashes are nearly always caused by credit problems. And some of you, as old as I am, remember back in the 60s that we went through the credit squeezes, didn't we? And followed by a recession. And the booms and busts were far more exaggerated than they are these days. But markets are always driven by supply and demand. And the reality of the fact is that the world's growing, we're all getting wealthier, we'll all consume, and growth will occur. To quote Buffett again, most people get interested in stocks when everyone else is. The time to get interested is when no one else is. Or we simply attempt to be fearful when others are greedy, and greedy only when others are fearful. So in terms of economic cycles, this is the investment clock, well used through investment circles, and it just really depicts the ever-repeating economic cycles from the top of economic boom to the bottom of depression or recession, and how that influences the rising markets of comparatively interest rates, property and shares. And these cycles just repeat and repeat and repeat. Since 1980, there have been share market corrections in 1987, 1994, 2001 and 2008-9, all roughly 7 years apart, and all coinciding with the changes in the economic cycles. This cyclical trend supports the fundamentalist view I mentioned earlier, in that if you believe in one, then you automatically apply to the other. But consider this, after every negative year on the stock market, there have always been positive returns. In 87, it was followed by 2 positive years, 1990 by 2 years, 1994 by 7 years, and 2002 by 6 years. This graph indicates the movements in the Australian share market over the past 110 years. The green squares are the positive years, and the red squares are the negative years. So I put it to you that share market investing isn't quite as risky as one might think, when for only, on average, every 13% of the time, the market's in negative territory, and for 87% of the time, it's positive. And if you look at the fourth column from the right, 2009 returned a positive return of 33.4%. So folks, if you weren't invested last year, you just missed the before party. And all that was companies correcting their mispricing. It wasn't even the start of the economic growth, that's where we are now. The 100-year trend line of the Australian stock market says that we have to get back to beyond 7,000 points. And if you recall, in 2007 we got just below 7,000 points, and the trend line says that we'll get back to 7,000 points. The only thing I can't tell you is when that will happen, but it will happen. So folks, we're not making this stuff up. This is irrefutable fact. And that's the basis upon which we make our decisions, on things that we can be sure of, facts and figures that we can depend on. But success requires patience and keeping faith with the strategy. And we understand that when the market's going down and everybody's losing their head, it's pretty hard to keep yours.